Welcome to This Explainer. If you're a founder trying to navigate those chaotic, absolute earliest days of getting your startup off the ground, you're in the exact right place. We're going to map out the critical early days of funding today. Specifically, we're looking at the pre-seed founder's roadmap. We really want to decode the smartest, most efficient way to secure that initial capital, so you can actually build your product instead of just endlessly talking about it.
Okay, let's dive right into this. It's kind of painful, but it's a question we absolutely have to ask. Why do most first-time founders waste their first 9 months? It's a brutal reality in the startup ecosystem. So much time, so much energy, and just raw passion completely poured down the drain on a failed fundraising strategy that, honestly, was doomed from day one.
And here's the stark, no-nonsense answer. They pitch venture capitalists way too early. It's really that simple. A lot of first-time founders think, okay, startup equals venture capital, right? But VCs are looking for de-risked opportunities. They want to see companies with real traction, actual revenue, a proven team, and, existing customers. Your pre-seed startup, as brilliant as your idea might be, is literally none of those things yet. You're pre-product. You're pitching a vision, not a de-risk business.
So, how do we fix this? Well, here's our map out of the trap. We're going to quickly hit on the big startup mistake, compare angels to venture capital, look at the pre-seed reality, give you a step-by-step roadmap, and then talk about what happens beyond the check. It's a complete guide to securing your pre-seed capital the right way.
So, kicking things off with Section 1, the big startup mistake. Let's look at the totally brutal timeline of pitching too early and why chasing institutional money before hitting your milestones is incredibly dangerous.
If you follow that typical path of approaching VCs first, your timeline plays out like a slow-motion car crash. Months 1 through 3, they're entirely eaten up just building these overly complex pitch decks and financial models, begging for warm intros. Then months 3 to 6 hit. That's when you finally get your first VC meetings, which are followed almost immediately by your first rejections. So months 6 to 9 are spent desperately revising your approach, doing more pitches, and getting more no's. And month 9 plus, well, hey, you might actually finally get a yes, but by then, congratulations. Your momentum is completely dead and your capital runaway is basically a myth. It's just an exhausting way to build a business.
But look at the alternative. On one side, we have that typical, grueling path we just talked about, 9+ months of VC rejections and an exhausted runway. But on the other side, we have the smart path. This is taking just 8 weeks to close a $300,000 to $500,000 round from angel investors. I mean, it's a staggering difference, right? One path literally drains your momentum, the other actively fuels it.
Now, what's really interesting about this next part is how it sets up our core strategy. Section 2, Angels versus Venture Capital. To actually master this roadmap, we absolutely have to understand the stark differences between these two totally different investor classes.
This quote from our source material really hits the nail on the head. Angels are individuals betting on you. VCs are professionals managing other people's money and need defensible theses. That word, you, is the whole secret here. Angels are high net worth individuals investing their very own money. Actually, they're often former founders themselves. They serve as this essential bridge between your personal savings and that massive institutional capital.
Let's break down exactly how different they are. With angels, you're looking at check sizes anywhere from $10,000 to $500,000. And their decision time? We're talking days to weeks. They move incredibly fast because they're deciding for themselves, and their focus is purely on your potential. Now flip that and look at VCs. Check sizes start at $500,000 and go way up into the millions. And because they're deploying other people's money, their decision time takes months of heavy diligence. Their focus is strictly on traction and revenue, hard proof that you've already figured the puzzle out.
Which brings us right into Section 3, the pre-seed reality and how modern rounds actually work. We are stepping away from the theory now and looking at the nuts and bolts of an actual 0 to 6 month pre-seed round.
10 to 15%. Seriously, burn this number into your brain. When you're going out to raise that target of $100,000 to $500,000 to get your initial runway, 10 to 15% is the typical equity dilution you should expect. You're trading this slice of equity to secure the runway you so desperately need to hit those first real milestones, like a prototype, your first few customers, or that initial revenue.
But how do you actually go about collecting that money? Well, the modern founder's secret weapon is the angel syndicate. Basically, a syndicate is a group of 10 to 30 solo angels who pool their capital together so they can make investment decisions as a single entity. Platforms like AngelList, SFC, and Forge have completely revolutionized this space. Syndicates are how modern rounds get done, mainly because they keep your cap table, which is your official record of who owns what, incredibly clean.
And this brilliantly illustrates why syndicates are such a massive win for a founder. Instead of trying to wrangle 20 different people, you just get one single $300,000 check. You'll have a lead angel who really champions your deal and maybe puts in $100K. Then you have core members who follow that lead with another $150K, and finally some smaller allocations rounding the whole thing out. It's amazing because you only have to deal with one main champion instead of 20 separate admins constantly chasing you for updates.
All right, let's get into action mode with Section 4, your step-by-step roadmap for executing this 8-week raise. This right here is your highly actionable playbook for securing the bag in just 2 months. Let's go.
Here's the 4-step execution plan. Step 1, map your warm network. We're talking mentors, former professors, old colleagues, industry peers. Step 2, build your target list. You're aiming for about 20 to 50 angels for every 100 grand you want to raise. Step 3, the pitch. Now listen closely here. Your pitch is about your story, not a complex financial model. It should literally be a 3 to 5 minute conversation explaining the problem, your brilliant solution, and why your team is the one destined to build it. Honestly, angels do not care about a 5-year financial projection for a product that doesn't even exist yet. And finally, step 4, create momentum.
Let's double-click on that momentum, because this is where the real magic happens. FOMO and trust cascades. The hard truth is, fighting for those very first few commitments over the first 2 to 3 weeks, it's the hardest part of the entire process. But once you get 2 or 3 angels to actually say yes, it triggers this wild chain reaction. Other investors hear that a trusted name is in, they get major FOMO, and they rush in to participate. One single yes truly changes the entire dynamic of the round. It spreads like wildfire.
But as you're out there executing this, there are some serious red flags you absolutely must avoid. First, and we've established this, do not pitch VCs pre-traction. Just don't. Second, do not give friends and family the exact same terms as experienced angels. The expectations are completely different and it'll cause headaches later. Third, and this is absolutely crucial, don't take toxic checks. Just because someone is waving money in your face doesn't mean you should take it. You have the power to say no to bad money. And finally, don't overdilute early. If you give away 30% of your company right now, you are literally destroying your chances at future funding rounds.
Which leads us perfectly into our 5th and final section, beyond the check and playing the long game to Series A. Because executing this angel strategy doesn't just get you cash, it fundamentally alters your entire long-term trajectory.
So the crucial point is this. You aren't just getting money. The real advantage of angels is that you're building a squad of 10 to 15 highly connected people who essentially become your personal advisors and champions. I mean, they provide warm introductions to massive customers and the press. They offer vital one-on-one mentorship when you, inevitably, need to pivot. Plus, when you have good, well-known angels on your cap table, it gives you instant credibility with larger funds down the road. It's like having a built-in team holding you accountable and pushing you forward. Just look at how this changes your timeline compared to that absolute disaster we looked at the very beginning. Months 0 to 2, you raise your pre-seed from angels. Boom, done in 8 weeks. Months 3 to 12, you actually get to put your head down, build your product, acquire customers, and hit those big milestones using the runway you just secured. Then right around months 12 to 18, that's when you go and raise your Series A from VCs. Raising from angels first actually compresses your timeline to a successful Series A, mostly because it gives you the runway to build the undeniable proof that VCs demand.
So as we wrap up this explainer on the pre-seed founder's roadmap, I want to leave you with one final, absolutely critical question to ask yourself. Are you wasting your time right now chasing VC validation without any traction? Or are you smartly building the angel relationships that will actually fund the runway to get you there? Think about it. The choice of which path to take is entirely up to you.